if these founders are so good that you're investing in them, it is also a high priority that these founders can also go to other VC funds or other angel investors. So how do you ensure that as a fund that these kind of founders should be coming to us, and how do you ensure that these founders know about us? So how do you market your fund in that way that your deal flow is coming from these high quality founders?
A few things. One, going on podcasts like this, putting out the call. I'm very open to cold inbound. So there's not very many funds that are open to anyone reaching out to them. Most a lot, and then a bunch that say they aren't really, and they really, really want you to find a warm, warm inbound and to connect, and only look at warm inbounds. But being open to cold inbound, I think gets me a lot more deal flow than other people might, just because, at least relative to my fund size, reputation, brand, everything else. Listen, I think Andreessen's probably doing okay, Sky's probably doing okay on their deal flow. But in terms of, fund size and solo GP and, a few years in the industry, I think the volume and quantity of deal flow is higher. Then, in terms of just trying to be a presence in general on podcasts, on Twitter, running events, things like that are, trying to be a value add in the ecosystem, in lots of different ways, either in putting out content, in connecting people and connecting folks, in being open to conversations, even if there isn't, necessarily a fit for me. I do a lot of, not a lot of, but I do a lot of conversations with folks in the D2C or marketing space, even if they're not ready to raise before the raising or in between raises and not, currently raising, and just try to build the network and reputation through those conversations as well. And try to do, even when I'm diligencing a company that is in my wheelhouse and is raising. When I try to do diligence, I try to make sure that it's value add diligence. We're not trying to make them do homework, but the idea is, hey, how are you thinking about customer cohorts? How are you thinking about discounting? What does AOV look like? What does product expansion look like? I see that you guys are not currently spending a lot of money on marketing. What does it look like after this raise? Things that they should or should be thinking about at some point. Trying to have those conversations and help them think through that as well.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast, and today we have Andrew Gluck with us. Andrew is the general partner of IrrvrntVC, a firm focused on early stage companies in the DTC, AdTech and NextGen Commerce areas. He especially loves partnering with first time founders so they can learn from the mistakes he made as a founder. Prior to that, he co-founded and ran Agency Within, the fastest growing independent DMA with a focus on direct response, data-driven marketing. He managed close to $1 billion in spend for clients like Nike, Billie, Zola, Outdoor Voices, Goop, and Etsy. In this episode, we'll cover how he started investing, building the biggest digital marketing agency in the United States, raising a $10 million early stage fund, what he looks for in companies before investing, where does majority of his deal flow come from, how he stands apart from other investors, change in investing strategy owing to the recent slowdown, and much more. Without wasting any time, let's dive straight in.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Andrew Gluck with us. Andrew Gluck is the general partner of IrrvrntVC, a firm focused on early stage companies in DTC, AdTech, and NextGen Commerce areas. He especially loves working with first time founders so they can learn from the mistakes that he made as a founder. Prior to that, he co-founded and ran Agency Within, the fastest growing independent DMA with a focus on direct response, data-driven marketing. He managed close to $1 billion in spend for clients like Nike, Billie, Zola, Outdoor Voices, Goop, and Etsy. Andrew, I'm so glad to have you here on the podcast. How are you doing?
I'm doing great. Thanks. I appreciate you having me.
It's a pleasure, Andrew. So to start with, can you give us a little background about yourself and how you started investing?
Yeah, sure. So as you kind of touched on a little bit, I had a digital marketing agency. So spent about a decade in the digital marketing ecom world. Started an agency in 2014, co-founded that with a partner, and grew to be the largest independent digital marketing agency in the U.S. Working with brands, enterprises like Nike, Intuit, Shake Shack, Spanx, Etsy, startups like Goop, Rothy's, Helix, Bendier, Billie, Zola, Lola, Petflow, Trade Coffee, and others. And then had a successful exit from that in 2018. And then after that, took a little bit of time off, spent with the family, played a little golf, a little tennis. But then when I was trying to figure out what I wanted to do next, I looked back at kind of the agency life and wanted to focus on, hey, what were the things that I really enjoyed? What were the things that I really loved? What were the things that I didn't as much? And how do I do more of what I love and enjoy? And realized that there really was this passion and enthusiasm for working at kind of the early stages, working at that 0 to 1, especially working with founders and founding teams. that really excited me. So start to get more involved in that space. And then from 2019 to 2021, over a period of about 2.5 years, made 25 angel investments. Just dove right in, started to learn more about the space, reading everything, meeting everyone that I could, going to tons of events in New York City pre-COVID, and that was all great and fun. And like I said, made a bunch of investments, got to meet a bunch of really smart founders, a lot of other great investors, and kind of established myself good brand, good reputation in the industry, good track record and performance on those investments. And so went out and end of last year, tail end of 2021, raised a fund, really focused on kind of continue to do what I did as an angel investor, but do it just at a larger scale.
Yeah, I heard about that. You raised a $10 million fund, and that's no easy deal. So, can you talk me into what does it really involve for you to go out there and raise a fund to convince other investors to come with you and put their money in? So, what does it take, and how do you reach out to other investors? Like, tell me more about it.
Yeah, for sure. So I think probably now would be much harder than it was about a year ago when I started the process last summer when I went out to raise money. I originally was targeting raising around $5 to $7 million. I really wanted to just do kind of crawl, walk, run. So crawling, as angel investing my own capital, walking with a proof of concept fund, and then running with after that a larger fund. Building out a firm more than just one fund. But fortunately along the way, was able to connect and meet with people that were honestly had conversations with folks, including my anchor LPs, Apple Holdings, that I hadn't anticipated having until later on. I thought that they would want to see even more of a track record and come in later, but they really believed in me and wanted to invest early. So they're the anchor investors, and then um, one thing that I did I think really well, um, somewhat intentionally, was kind of over those 2.5 years of angel investing, I really was pretty good and strong about focusing on investments that I would do as if I was a fund. So really, a lot of times, I think early on, a mistake that some angel investors make that I've seen, and listen, I wasn't immune to it at all. I wasn't immune to it completely. Is focusing on deals that kind of make sense and pencil out, but don't have the potential to be those home runs and those outlier successes. And so I think I did a good job of that, which really helped me. I also stayed really true to my focus and niche around e-com, digital marketing, advertising technology, which I think people appreciated. And in the hype of everything that was going crazy, from the time that I was investing early 2019 to end of 2021, with valuations, probably outpacing the value that was being generated by those companies. It's one thing to pay a multiple of ARR. It's another thing to pay 100 times that ARR. I was really focused on early stage and really focused on being price disciplined. I think there were deals that I missed because of that, but I think having that kind of consistent approach and discipline was really valuable. And so, kind of investors, when I met with them, and end of last year, we were still in that kind of euphoric phase. But they appreciated that kind of authenticity around my focus and that discipline. And then, obviously, I don't want to, not talk about or diminish, the privilege of, the rooms that I'm able to get into due to my network and due to my background. And so I think that definitely played a part in it as well.
Absolutely. And like you just said, that you have an amazing track record with your investments. And for that reason, you have been able to raise this bigger fund. Like that played a big part, right? So, to spot these outliers, you say that your strategy was different, that you were looking for outliers from the start, and you're investing in early stage. So, in early stage, there is not much of proof to show for companies that, okay, we have done this, we have done that. So, at that stage, how do you spot these outliers? What traits do you look for at that stage?
Yeah, I'd say I'm really focused on kind of founder market fit. When I talk about that, that's kind of three different things: founder or founders or founding team. Are these founders and founding team exceptional, remarkable? Do they have the ability to create, a really huge company? Do they, in ways that I kind of diligence that, I look at their investor updates. I look at obviously their experience and background. Do they understand what greatness is and what greatness looks like? I do think that's really important. Um, Even though I over-index on first-time founders, um, market the market that they're entering, does this have the capability or ability to lend itself to a large multi-billion-dollar exit? Because if the outlier success, if a home run, for them is they're raising at 10 and they get to a $100 million exit, everyone's going to be happy with that at the end of the day. But if that's the upper bound of what's possible, that's a 10x, and then after dilution you're looking at 7x. Like it's not a great outcome for a fund investing into an early stage company. So the market really needs to support 500 million, $1 billion, $5 billion exits, and then founder market fit. Do these founders have something exceptional, not just in general, but specifically about this market? Have they spent time in the market? Do they kind of understand all the pitfalls of the companies that have tried this before? Do they have a differentiated approach in terms of either go to market, in terms of product, in terms of niche and audience? What is it that's going to get them kind of that jump start and kick start to get going? And that's kind of the areas that I focus on. And then I bring obviously my background and experience in digital marketing, in AdTech into that, right? So my goal is when I'm meeting with founders is, to kind of get through the initial business model and understand that, hopefully over email on with their deck pretty quickly, and then really to have a conversation, that's much more about a conversation than it is about going through the deck around, product roadmap, go to market, product differentiation, think through, how do they think through hiring? How do they approach kind of capital raising, and really kind of get a little bit deeper, pretty much more, a little bit more quickly than I think other funds sometimes do.
Got it. And for these founders as well, like if these founders are so good that you're investing in them, it is also a high priority that these founders can also go to other VC funds or other angel investors. So, how do you ensure that as a fund that these kind of founders should be coming to us, and how do you ensure that these founders know about us? So, how do you market your fund in that way that your deal flow is coming from these high quality founders?
Yeah, I think a few things. One, going on a podcast like this, putting out the call. I'm very open to cold inbound. So I there's not very many funds that are open to anyone reaching out to them. Most a lot, and then a bunch that say they aren't really, and they really, really want you to find a warm, warm inbound and a connect, and only look at warm inbounds. But being open to cold inbound, I think gets me a lot more deal flow than other people might, just because at least relative to my fund size, reputation, brand, everything else. Listen, I think Andreessen's probably doing okay, Sequoia's probably doing okay in their deal flow. But in terms of fund size and solo GP and a few years in the industry, I think the volume and quantity of deal flow is higher. Then in terms of just trying to be a presence in general on podcasts, on Twitter, running events, and things like that are try to be a value add in the ecosystem. In lots of different ways, either in putting out content, in connecting people and connecting folks, in being open to conversations, even if there isn't necessarily a fit for me. I do a lot of not a lot of, but I do a lot of conversations with folks in the D2C or marketing space, even if they're not ready to raise before they're raising or in between raises and not currently raising, and just try to build the network and reputation through those conversations as well, and try to do even when I'm diligencing a company that is in my wheelhouse and is raising. When I try to do diligence, I try to make sure that it's value add diligence. We're not trying to make them do homework, but the idea is, hey, how are you thinking about customer cohorts? How are you thinking about discounting? What does AOV look like? What does product expansion look like? I see that you guys are not currently spending a lot of money on marketing. What does it look like after this raise? Things that they should or should be thinking about at some point, trying to have those conversations. And um, help them think through that as well.
Absolutely. So basically, trying to gauge the understanding of the founders of what they are pitching. Do they actually know about what they're pitching and the future aspect of it, right? Also, like when a pitch has come to and you're excited by the pitch, you are questioning the founder and you're in talks. So, how much time does it take for you to get interested in a deck and to sign the check? How much time does due diligence take, and like the time frame that an investment takes?
Yeah, I try to keep it to like roughly like a month. I definitely try to get quick no's back to people also. So, um, I think the standard that I try to hold myself to is for cold inbound is trying to get back to folks within a week or so. In terms of where I get back to them. I think I'm probably right now, like honestly, transparently, a little bit behind just because of some you know, Father's Day, my kids are off school, things like that. But get back in about a week to 10 days from cold inbound, whether it's just a quick no, here's some other resources, or hey, here's some questions, or this looks really interesting, let's hop on a call. And then diving in, kind of goes from that. Usually, questions to a phone call to more questions to another phone call, and then make a decision after about two calls. If they're in New York, try to meet up in person as well. If they're in the area. Um, and then, yeah, that usually takes about, less than a month to get to a decision. And then, when it was signed and wired, it could take another week or two, depending on sometimes when they're legal or my legal. But it's usually pretty quick because we're mostly talking about safes or convertible notes.
Got it. And since you're open to cold inbounds, that just says that your inbox must be flooded every day, isn't it? Because since you're openly open about, okay, you can just cold email me your pitch and I'll look into it. So how do you manage your email? Like, is it not overflowing? Have you hired an assistant who just goes through your inbox before the significant one go to you? How do you manage it?
No, I have right now. I mean, I have an executive assistant. They don't deal with deal flow, but really, I'm focused on, um, trying to figure out a strong process for that. I'd say I probably get, I'll tell you actually, last week, um, just about 60 60 cold inbound a week. So it's quite a lot. I think I do a pretty good job again about filtering. So one thing that I've done is I've really kind of updated my um, my form on my site for cold inbound to really try and be able to, when things are not a fit, filter them out more quickly, depending on, stage or geo or sector and things like that. And then as well, I also try to, um, make sure that I filter out, transparently. A lot of cold inbound is not good. And so I try to filter out a lot of the, folks who have not spent a lot of time thinking through their product or their market, who don't really understand how venture capital works, and doesn't mean that if they don't understand how venture capital works, it can't be a fit. But a lot of folks again are, you know I'll give you an example: restaurants, right? Like, I'm not going to invest in a restaurant, right? It's not a venture capital backable business. You're building a virtual kitchen, you know, software or something like that in the space, sure, okay, let's talk maybe. But a restaurant, a restaurateur who's trying to open up 2, 3 locations, it just doesn't have again upside potential of that is needed for venture funding.
Absolutely, I agree with that. Let's talk about your most interesting investment you've made till date. If you're open to talk about that, if you want to like mention the most contrarian investment you've ever made, like the most outlier kind of stuff that no one else would have touched it, but I went ahead and invested in that, and the most exciting ones, two of these.
Interesting question. Trying to think of the most contrarian. Um, I think Caraway was probably contrarian in some ways. I mean, it was really, difficult for Jordan, the founder, to raise. He raised took him a long time. I mean, there were a few other direct consumer kitchenware companies that already started at the time when he was raising in 2018, 2019, and eventually launching in 2019, tail end of 2019. The first raise that he did, he raised from like I don't know, ridiculous number of people, 5K checks, 10K checks, 15K checks here and there. And at the time, contrarian in that a lot of folks thought, oh, why does the world need another kitchenware brand? Which is, how I went into the meeting as well. After meeting Jordan, it became clear that the world needed a kitchenware brand started by Jordan Nathan, not just, another kitchenware brand. And so I think that's, one that at the time was contrarian in that, not a lot of folks were ready to invest at the time. But I was. And again, one where founder market fit was kind of off the charts in terms of the way he was thinking about the business, his approach to the business as well. The other question, sorry, was what has been my most successful investment, my proudest investment? How did you phrase it?
I asked about the most exciting investment, like the company that you're most excited by personally.
Most excited about? Oh gosh, I have to say all of them, right? They're all my favorite children. But I'll talk about one that I'm excited about in the moment. I think one that's really interesting. Where I was an early investor as well. Is a company called Revenue Roll, and so what they do is they kind of take a step back. At the agency, in my agency, we worked with a lot of enterprise brands, charging anywhere from the beginning, our minimums were lower, but by the end, minimums of 5, 10, 15K a month just in service fees, which is obviously unattainable and unsustainable for smaller brands who aren't spending a lot on marketing. And so what Revenue Roll does is try to combat that with kind of three key ways. One is an analytics platform that includes much better tracking, especially in a post iOS 14 world, around performance. Two is they'll actually manage your ad spend for you if you want, and they'll do it in a way that is really focused on performance and incentivized based on performance increases and improvements. And so even if you are a smaller company, you're kind of getting what you pay for in a good way there. And then three, in terms of lending out capital for that growth to companies. So I'm just really excited about what they've built around kind of attacking all three of those problems that I see from, the SMB side. We turned away, again, tons of companies that just weren't a fit, just weren't large enough for us at the agency. And there's other agencies and other options out there that are good and adequate, but I think what Revenue Roll is building in terms of kind of attacking those three things around better analytics, better funding and capital to facilitate and fuel that growth, and then better performance management of those campaigns that's really tied to the actual outcomes, I think is pretty exciting.
Yeah, for sure. I'll make sure to link to those companies in the show notes below so that others can also check those companies out. Also, talking about investments. So once you've made the investments and you have a decent enough portfolio, so how do you track your investments? Are these founders going to report to you on a weekly, monthly, quarterly basis, or how does that work?
Yeah, so from the fund, I typically do a weekly a call with the founders and founding team, either every 2 weeks or every month. It depends really on what the founders want and also just where they are in their business, right? So a company that's heads down building out the product and not really focused on go to market at this point, probably catching up once a month is enough. We also email, text, calls in between, but having at least once a month on the books to catch up is always great. And a lot of times what we do is we schedule that like shortly after their monthly updates. So they'll send their updates on the first, second, fifth of the month, and then they'll do their monthly call with me and with other investors shortly after those updates go out. So I come prepared for the meeting with understanding where they are, how they're thinking through the business at that point, and then thinking through ways that I can, the number one question I always try to ask is, okay, what's going well, it's not going well, where can I help, right? Where can I add value, right? Because I'm here, I'm happy to talk through, the business updates and get better understanding for me is always helpful. But at the end of the day, my goal is, the 30 or 60 minutes that we're spending together, give me 2, 3, 5 things that I can do to go out and do over the next week to 2 weeks to help propel the business forward. Maybe it's, hey, take a look at our pricing. Hey, we're hiring for this position. Do you know any good recruiters? We're thinking about compensation. How do you think through that? Can you send me some articles or best practices on thinking through hiring and equity and comp, right? And so I'm always just trying to, again, I over-index on first-time founders, and I'm a founder myself. We weren't VC backed, we're profitable from kind of day one, day zero. So don't have that experience, but I've gone through a lot of fundraisers. I've gone through a lot of companies' ups and downs, both as a founder, as an investor. So I probably come with just more breadth of experience, and so trying to bring that forward and help in that regard.
Yeah, and VCs need to be so resourceful in all these different areas of business, whether it's hiring or raising a new round or hiring people or doing any sort of thing, managing, setting up a management system, setting the pricing, like you said. So all these different aspects. If you, the VC yourself, is handling all these things for so many portfolio companies, then does it not get overwhelming for you, or do you have a team in place who takes care of specific aspects of the business, like this team will help with hiring to our portfolio companies, this team will help with this thing? How do you manage that stuff?
Yeah, no, it doesn't. I mean, gets overwhelming, but at the same time, like there's just ebbs and flows, and I think it also is, again, different companies have different seasonality around them, different kind of growth periods and growth times where they need or could use attention more than others. I think this is will be a challenge for me as I continue to go and grow. As of now, the fund's made about 10 investments so far. We'll end up making between 20 and 24 investments, so a little less than halfway through. So it's definitely something that I'm mindful of, right? If I have angel investments that I've made, which obviously I probably have long-standing relationships with founders that still want help and advice every now and again, a little bit more on an ad hoc basis, but then even still have 20 companies and doing even a call every single month with every single one of them is it's 20 calls. That's 10, 12, 15 hours a month, on top of updates, on top of they're going out to raise and need help with the deck, and they're going through the opposite, maybe slower growth, and they need help thinking through restructuring and planning. So there's always kind of stuff to do. I think one big thing that I do, I try to do, is to not ever overpromise. I'm a solo GP. You get access to me and not a team, which is good and bad, right? So areas that I can help, I try to talk through pretty clearly. And then in terms of time, resource, bandwidth, it hasn't been an issue yet. It probably, at the same time, what ends up happening is invest in 20, 25 companies. Those companies, grow and develop, and some obviously don't make it, or some, sit and kind of grow more slowly and aren't really on that sort of trajectory anymore. And then some, go and grow beyond you, and that's great and good too. It's a good problem to have, right? Where they go ahead and even if I was the lead investor, trusted confidant sometimes for the founders, they replace that, and that's totally good. It's healthy, right? Where if the fund invests a couple $100,000 into their pre-seed round and then follows on their seed, but now they have a lead seed investor, and then they go out and raise an A, and there's a fund putting in $10-15 million into the A, probably rightfully so, in terms of time, attention, where both the founder and the relationship naturally is going to grow is going to be in those places. I think I will aim to continue to be kind of that place where they can go and get that kind of, a little bit more trusted, one-to-one type relationship. Obviously, I have a fiduciary responsibility to my LPs, but at the same time, so this is a long game. I want to be doing this for the next 30, 40 years and being respectful and hopeful for founders and doing the right thing by them is really important. So, the goal is to continue to be that kind of trusted resource for them, even as they kind of grow beyond needing to connect every month or even every quarter, to still just be that person they kind of can go to in that, hour of need.
Got it. That's a nice approach. And also talking about the recent slowdown and saying that the investment world has slowed down almost suddenly and the valuations are going to start going down and the investments are not going to be available so easily. So, how has your approach changed, or if it has changed in the current times? So, how has your investment strategy changed?
Yeah, I think I was always relatively price disciplined, as I've alluded to earlier. Always focused on the early stage. I think to not take too long on this point, but on the background, but you know, you have some what I call good, healthy increases in valuations at the seed and pre-seed stage over the past few years, where 5, 10 years ago, and again, this is from reading and learning from mentors and advisors more so than actually having been in the industry 5, 10 years ago. You had companies raising $1 million at 3 million, 4 million pre-money, and that's because they needed to set up their own servers, to set up their own hire the engineers to build out and even just get to like beyond a slide presentation, but beyond just a deck. Now, with even before a company goes out to raise, they'll have built like an MVP or even a little bit beyond an MVP, right? Because there's just a lot more resources available. Exited founders who have been at large companies and had good exits from being at those companies early. There's folks who have um, you know proliferation of talent and of information through YC, through Twitter, through podcasts, through articles. You have low and no code stuff going on where now it's not even necessary to have a technical founder, technical co-founder, CTO at the earliest stages. You have obviously AWS and Google Cloud and Azure and everything else. And so now, like that pressure where it took, instead of $1 million at 3, 4 million pre, to now go out and raise 1.5, 2, 3 at 7, 8, 10 pre. Some of that probably makes sense, right? Because they are getting that much farther and have proved and de-risked, a little bit more. Then you have obviously, the combination of the crazy valuations due to the zero interest rate environment, due to larger exits and stock market performance and seeing larger exits, larger AUM from the funds, and kind of all of that was cyclical and one built off the other, built off the other, built off the other, and so you had probably again like we mentioned people funding off 100 times ARR and things of that nature. That was probably unhealthy and has corrected, maybe too much now, but has at least corrected a little bit. So, when I look at that and think through that, the goal is still to just be, take the approach of being disciplined, of being thoughtful, of really focusing on, again, are these founders phenomenal? Is this market large enough for an exit? And I'd say the area that I probably think about more now than I did 5, 6 months ago is, are they raising enough cash to prove something, to de-risk X, Y, and Z, to prove out this or that hypothesis, and is that enough to then go out and raise the next tranche of capital, right? And so that's something that I think you have to think about always. But before it was okay, they're raising $1 million, they'll figure it out, and even if they don't, there'll be someone who's willing to continue and just kind of write that next check, because they'll have gotten at least that far. And now it's like, okay, if they actually, let's pretend they say, hey, we're raising $2 million and we're going to prove that X, Y, and Z. Great. We're now here 9 months from now, 12 months from now, and they have 3 months of runway left, and they're going out to raise money. Like, is there going to be a buyer for that? For that equity? And I think that's something that I have continued to focus on. I still obviously always trying to get better at everything, but still need to get better at is understanding kind of how you know later seed, larger seed rounds are priced and thought about. Series A are thought about and priced about, and so thinking through kind of that approach and understanding, and that way being able to go to the founders and be like, hey, you're not raising enough, or hey, like you prove that out, great, like you're raising at 10 million, you'll be raising at 10 million again, like good and bad, like that's just the way the market is today. And yes, it could change in 9 months, but it's not going to change that drastically, at least.
Yeah, got it. And that's a very nice take on how you do it. And lastly, I would like to ask you this question that has been bugging me ever since I got to know you about the name of your fund. It's called IrrvrntVC Fund. So, why did you pick that name, and what does it really mean?
Yeah, so it's a combination of looking for, I was looking for names that started with IRR. IRR stands for internal rate of return. It's how, venture funds get measured. They get measured on a lot of different metrics. At the end of the day, how much money they return back to their investors over what time period. And so I was focused on that, and then came kind of across the word irreverent, as I was thinking through, and it just really struck a chord with me. I think one of the reasons that the agency that I founded was so successful was because we brought that no agency experience, that lack of agency experience to the market. And we built an agency that we would have wanted had we been looking for an agency. And so I try to do the same thing here, right? I don't have the positive learnings of some other venture capitalists, but I also don't have the negative learnings. And so you know good and bad. I try to bring that irreverence to the fold every day. I also, we're, privileged to be working in, knowledge working, sit behind the desk most of the day, stare at a computer screen to make money. Like to try to bring that fun and tone and lightness to what we're doing. I think building companies and employing folks is powerful, important work. Building and ideas that better the world are great. But I want to have fun while I'm doing it, because I spend a lot of time doing it. And I think it's important to just bring that attitude and that positive kind of irreverence in a good way to what we're doing here, and not too much of a you know pedestal of the work that we're doing here.
Got it. Got it. That's super cool on your approach to how you're taking this fund, taking it from scratch basically, and showing the world a new take on VCs like you did in your agency business before. All right. So that was my time, and now I would let you tell our listeners about where can they reach you to seek investment, or maybe connect with you and talk about their business. So what would be the best way to reach out to you and maybe get some money from you?
Yeah, sure. Um, yeah, so as mentioned, very open to cold inbound. So if you are a founder focused on the U.S. Markets, and you're building a business in direct to consumer, AdTech, NextGen Commerce, anything in and around ecom infrastructure, marketplaces, feel free to go to irrvrnt.com. There's a pitch form right there. Again, I review every submission personally, get back to everyone again within about a week to 10 days. And you can also follow me on Twitter at IrrvrntVC. And yeah, I'm excited to see all the submissions and get to know folks that are interested in this world.
Absolutely. I'll make sure to plug all those links in the show notes below so that people can just click that link and reach out to you or your website. Thank you, Andrew, for doing this. It was a pleasure talking to you, and happy investing.
Thank you very much. I appreciate it. Thanks for having me on. This was a really fun conversation.
My pleasure.